Right, so now we are going to continue a lot of the themes that were raised in that last panel, actually, but from a different perspective this time, really focusing on energy and infrastructure. And I think we have a really fascinating panel to unpack some of those themes that emerged in the policy discussion, but also to turn it round the other way in terms of what we're seeing in the investment trends for energy and infrastructure as two major key areas of both the economy and also investment opportunities. So, running through the panel, so we have Peter Colosino, who's the Executive Director for Policy and Research from Infrastructure in Australia. We have Samuel Mary, who's the Vice President for ESG Research at PIMCO. We have Jorg Kell, who's the Chairman of Arabesque, but many of you will also know him from his long-standing role, including as Founding Director of the United Nations Global Compact, and also involved in the launch of PRI, and also the Principles for Responsible Management Education and the Sustainable Stock Exchanges, so clearly a glutton for punishment. And we also have Mike Hanna, who's Head of Infrastructure from IFM Investors as well. So lots of different perspectives, and I'm just going to dive straight into the conversation. And Jorg, I wanted to start with you in terms of that global perspective, and in particular from what you're seeing in Asia-Pac and the Asia region as well. You know, how are you seeing, from what we're hearing about some of those policy trends and the market and the technology shifts, how are you seeing that play out in terms of disruption and opportunity in investment across, across different regions in terms of energy and infrastructure as well?
Thank you, Emma, and allow me very briefly to salute IGCC, having been in that business.
I'll give you lots of time to salute us.
Really applaud you and your wonderful team. It's very important work you're doing, really, really important. Just a brief bird's eye perspective. I feel as if the journey is only starting now. Also, I got involved in '92 in Rio, and since then have kind of tried to push private sector forward. But I feel the evidence, the mood, the next generation, but above all, technology. Technology now is finally coming along, and big companies and investors realize there are viable options. And the options exist already, as we heard earlier. So in that regard, I think the real journey in many regards is only starting now. We heard about the S-curve yesterday, the famous S-curve, and how the International Energy Agency long underestimated the rapid diffusion of renewables. We know on the automotive sector, companies such as Volkswagen, which used to be in Dieselgate, now accelerate. They roll out the first mega-scale e-mobility approach this year. So I think what we are moving into, the world is very fragmented, unfortunately, more so and more so, and there's less and less political will for collaboration, which is bad for climate finance and bad for carrying along those markets which actually need to be carried along, which also explains why so many coal-fired power plants are still being built or under planning. But by and large, I would say we are moving into a new era where decarbonization combined with technological change shows new options on a truly, truly massive scale. And I would argue negative carbon is becoming the currency of the future, in a sense that it's inevitable that we move into a carbon-constrained environment, and policymakers often lag behind, and there's unfortunately not a coherent, consistent move forward. But it's happening already, and I could quote countries, in TCFD in Tokyo last week, it was phenomenal. The Prime Minister, the Minister of Industry, all basically showing flag and saying to their own corporations and investors, this is the way we want to go. 200 Japanese companies aligning with TCFD. On the data side, ESG, we started a journey in 2004 with a report, Who Cares Wins, wishful thinking, and we coined the term ESG then, but it took another 10 years before the empirical evidence came in. Now the empirical evidence is there that sustainable investing actually is not at the expense of return. So ESG investing, as the tilt mechanism is kicking in big time, $30 trillion. Mark Carney's leading role on this movement needs to be underscored. So there's a lot of moving things which kick in now on a really big scale. So that gives rise for optimism. Reality, of course, is we are still lagging far behind. Just 2 weeks ago, my firm came up with a carbon measurement for companies. The good news is 3,000 companies already disclosed sufficiently good, but the other 63,000 listed companies don't yet. And among the 200 biggest polluters in the world, corporate, a quarter of them doesn't even disclose emissions yet. And about half of them doesn't measure scope 3. So we still have a long way to go. But now all the big systemic forces seem to kick in with a lot of regional variations, and politics not unfortunately aligned at this point. But it's irreversible. It's driven by technology primarily, new opportunities. It's driven by the intergenerational power shift that has to come inevitably at some point. And it's driven above all...
The crushing inevitable that it faces us all.
And it's driven by the impact of climate change, the feedback on us. You can argue where's the threshold when society is finally ready to move, but it's bound to happen as the impact increases.
Yeah. All right, so an optimistic outlook, some challenges, particularly in data, but inheritably more or less moving in the right direction. Mike, is that your perspective from the infrastructure side as well? And how do you translate that in terms of your infrastructure portfolio as well?
Thanks, Emma. Look, we're seeing a great deal of change taking place across the infrastructure sector. IFM Investors, we're a fund manager. We invest in infrastructure around the world. We're probably one of the world's largest investors in the space with 50 billion under management. And the last 2 or 3 years, we're seeing some substantial changes taking place in the core infrastructure sector. As a fund manager, we have a fiduciary responsibility to our investors to maximise their returns. To do that, we want to boost revenue and reduce costs. But when we talk about disruption, the biggest disruptive factor we're seeing from that sort of P&L point of view is on the cost side. And the two biggest cost increases we're seeing is in energy and in insurance. And just on the energy front, we've seen annual increases across some of our assets of between 20 and 40% in a 12-month period for the energy costs of running an infrastructure business. So very substantial step-ups in very short periods of time. And insurance, I know you've seen pictures of bushfires earlier. We're an investor in Ausgrid, which supplies the power to this building and Sydney CBD. We're just putting in place our bushfire insurance for the next 12 months, and we're seeing a 20% increase in our bushfire coverage. The market has hardened significantly since the Californian bushfires over the last couple of years. And the capacity is stretched in that market, and we're confident we'll get the full coverage in place, but it's a 20% step up in costs. So the impacts are very real. They have a dollar value and require very active management from us as managers, our asset teams on the ground, and other players to try and keep those costs down and manage proactively across the energy space, and also proactive management of, even from a bushfire perspective, being well ahead of vegetation management and reducing the risk and giving the confidence to insurers that you're managing your business well.
Energy costs and insurance costs, it's almost the debate in a nutshell in a lot of ways in the Australian context. But Peter, I mean, again, in terms of the work that you've done recently with the infrastructure audit for Infrastructure Australia, just really keen to hear from your perspective how you're seeing, are you seeing those trends reflected in planning across the network? But also, just where do you see some of the biggest gaps for forward-looking planning in terms of infrastructure requirements as well?
Yeah, thanks. So the infrastructure audit is the second that Australia's undertaken. It's a document that we're required to produce every 5 years. Infrastructure Australia, interestingly, while being part of the Australian government, we are independent, so we're able to form a view in our own right, and therefore the path we tread on climate change is horrendously challenging for us, as you can imagine.
That sounds fun.
What I'd reflect, though, is we do fundamentally believe that both greater action on climate change is necessary, and that there's a large role for the energy sector to play. Interestingly, it's actually the transport sector in Australia that's the laggard, and I just can't underscore that enough. We have one of the dirtiest transport sectors in the world, and just a little sidebar, Noxious emissions, so not obviously climate change linked emissions, but noxious emissions kill more Australians than road accidents, which is absolutely shocking when you consider the level of attention on road safety. So, in fact, there's not a great deal of focus from the federal government on, I guess, a broader view of the negative externalities that can come from infrastructure, so both noxious emissions, deforestation and land clearing, as well as climate change, of course. And those issues, hopefully you can hear me better now. Those issues are all issues that the audit picks up on and issues that we're hoping to receive feedback on. So we have a submissions process that's open. I can see a lot of people in this room who I'd like to hear from as part of that process. So
shameless
this is
plug
just my
alert.
little shameless plug. Yeah, absolutely. But when we look out across the sector, we do see a lack of action on climate, as I've mentioned. We also see an energy sector that's transitioning regardless of climate change. So renewables are cheaper to provide into the grid. There's a greater opportunity to make a return on those assets. Not $1 has been invested in new coal capacity since 2013 in Australia. The money has gone to renewables, and that's because of the return. The transition for us now is to move away from, I guess, a pure investment in renewables to start to think more about firming capacity. We need to think more about pumped hydro, of course, which is the proven technology in that space. If we think about lithium batteries, or we think about hydrogen, both of which have opportunity into the future, going to the gaps, they still aren't necessarily the strongest commercial offering for investors. But there is absolutely potential in both of those areas for energy for export. And Australia's past as an energy superpower in an old energy world can be mirrored or reflected in the future in a new energy environment if we start to think about those sort of targets that we heard discussed earlier, like a 700% renewable energy generation figure.
Okay, so there was lots in there that I'm tempted to ask a series of questions on. I want to come back to transport. Also really keen to perhaps unpack a little bit more the very very patchy nature of our response. So, quite progressive in some areas, really not doing anything in others. But Samuel, first, I wanted to bring you in and perhaps loop it back to the global in terms of when you see these global trends playing out, but they're playing out very differently in each jurisdiction. How do you actually then take that information and incorporate that into a consistent carbon risk or transition risk management framework as well, from the investor's perspective?
So thank you very much, Emma. Perhaps to give you a bit of context about how PIMCO is approaching climate change as a whole, and particularly carbon and transition risk, we have been essentially developing a framework and a strategy with a range of tools in order to monitor and assess and analyze a wide range of economic disruptions associated with climate change, and sort of support our credit analysts and portfolio managers to ensure that we are enabled to not only understand what are the current trends, but also be ready for some of the potential uncertainties ahead and fast shifts that will occur in relation to policy, market, and technology trends. Regarding our sort of top-down framework that is then brought down to the bottom-up level, we are basically seeing, echoing some of the points that were made earlier, a clear, super secular trend towards tighter regulation associated with carbon at different paces, but that's what fundamentally is occurring. We do see on the technology side, obviously, a positive momentum associated with renewables and battery, but not perhaps, even if it's at an unprecedented pace, not at a pace that is fast enough in order to drive the underlying positive outcomes that we would like to see. Importantly, for carbon pricing, we also see a set of jurisdictions taking action, and that it's increasingly playing a prominent role, particularly in the European context, where it was recently revived, and there is a good momentum in this respect. Regarding how it is translated in our thinking, it's indeed down to the geographical and sector level nuances. So we have been looking into the sector-specific drivers associated with carbon. And I could also reflect on the point that was made earlier about air pollution. In our thinking about carbon, we constantly look for the association and linkages and synergies and trade-offs between basically carbon and broader sustainability issues, which are part of PIMCO's ESG framework. So for transport, obviously, we can't look at carbon without analyzing the air pollution element. We do see also some growing connection between physical and transition risks. So when we look into the food sector, for instance, or commodities as a whole, referring to soft commodities, it's critical for us that we understand the transition risk element and the carbon emissions associated with palm oil, with soy, and a wide range of other sensitive commodities in a broader context that is thinking about water, that is thinking about biodiversity, deforestation, and a range of other secular growth themes that are ultimately going to determine the extent to which these risks are going to affect issuers under coverage and become prominent credit risk factors. If we take a step back, however, the only sectors for which climate change in the context of transition risk took center stage in credit markets in the recent period were utilities and auto. In other sectors, we obviously see significant underlying disruptions, but perhaps not being as prominent as one would expect them to be. The key question is what will be next. For instance, thinking about other transport segments than auto, shipping and aviation, and the same logic applying to heavy industrials and a range of other sectors for which the super secular trend I was describing is basically becoming more intense and more impactful for the issuers under coverage. And as a last step, as part of our thought process on the underlying credit risk implications, we obviously delve into the sector-specific drivers at an issuer level, which implies in practice that we will look at a broad range of metrics that enable us to map the possible winners and losers associated with that trend. At a high level, obviously, the life cycle carbon emissions intensity can be a useful proxy to get a sense of issuers' positioning with respect to a possible accelerated energy transition I was addressing earlier. But there are a broader range of metrics that capture some of the possible nuances. That means that some issuers will be primarily affected and more affected adversely than others. That means, for instance, when thinking about energy in the US context, that we will need to look at their exposure to state-level regulations that are already becoming actually stricter, regardless of what's occurring at the federal level, that may be driven by broader environmental concerns, broader social concerns, not carbon per se, but it's playing a role, and that's something that is important to capture. We also want to look at the cost positioning, the business model, the extent to which issuers are taking steps to be ready and to potentially move faster than the rest of the peer group. So these are the sort of signals that we think are important from a fixed income portfolio management standpoint in order to capture some of the possible opportunities.
Okay, great. Again, there's a lot I could come back to in there, but I guess I also, Mike, if I could turn back to you, I'm also keen to understand, you understand the macro landscape, you can see the disruption playing out, it's emerging in credit risk, you're seeing the infrastructure audit emerging. What do you then do about it from a fund manager perspective? Like, how do you take that information and translate that into IFM's approach, for example?
Yeah, look, the external environment's important, but our focus is very much at the asset level. And going back to my earlier comments, you see.
So you go back and buy insurance, and you kind of go, "Okay, this is real now."
Yeah, it's a big wake-up call. And you see costs increasing, and so it's our job to reduce those as much as we can. And there's broader themes obviously at play, as we've discussed here, around the broader sort of stakeholder environment. And investing in infrastructure. If we look at our portfolio here in Australia, our asset leases or concessions, the average lease duration is 86 years. So our ports and airports, we've still got to hopefully own and operate those for another 86 years. We're managing money on behalf of a range of super funds. Their youngest members will be 18 today and hopefully will live for 70, 80 years. So you're looking at a confluence there of assets and members' money that extend into multiple decades.
Yep.
So we need to take a long-term approach on how we're managing these assets. And yesterday we were very honoured to receive an award from IGCC for our carbon reduction initiative, which we launched or announced in August last year. And that's a culmination of a number of years' worth of work, Emma, which was sort of kicked off back in 2016. So following the Paris Agreement, we made a commitment to actually measure our carbon emissions across our Australian infrastructure portfolio. Working to the old adage that if you can't measure it, then you're not going to manage it. And then in the third year, which was last year, we moved to actually set some hard targets for reducing those emissions, with a view obviously to reducing costs and reducing risks, both at the micro but also at the macro level. And that was a really interesting process. I had to make a decision to deploy, up to 6 people working on this over the course of a year. But the cost benefit was obvious to us. We knew costs were increasing. There was a practical way to manage that, but also achieve a range of other objectives by, 1, measuring emissions, and 2, working with our assets and consultants to put in place some hard targets. So we're hoping to reduce emissions by between 8 and 25% across our assets by 2024, and up to 100% for some of the assets by 2030. So rather than just put aspirational targets out there that we want to be or we hope to be emissions neutral by a certain date, it's a bottom-up systematic process to figure out what we can do, what projects would need to be implemented, and what the return ultimately is to get those emissions down.
And how have the assets responded to that? The asset owners themselves, how have they responded to that? Has it been a full partnership model? Was there a bit of resistance? Has there been a bit of oh my God, how are we going to achieve this? How's that process
mixed
also?
Bag, Emma.
Yeah, mixed bag.
Some very progressive and want to lead the charge. Others reacting like, oh my God, what does this all mean? And we don't have the staff, the time, the inclination. But it's as much around capacity building across the infrastructure space and certainly at our asset level. We also have a terrific relationship with the Clean Energy Finance Corporation, who are an investor in our fund. So there's a combination of intellect and experience, and some assets have been doing this really, really well for over a decade. Some are coming to the party for the first time, but over the course of the last 12 months, I think we've done a great job in building capacity across the space, putting in place those targets, and everybody now feels very confident that it's achievable. We're not asking them to do something that's aspirational. It's practical, it's pragmatic. We can point to the projects, support from the shareholders and investors to achieve those outcomes.
What about the companies as well, from your perspective? I mean, how much are you seeing a sort of similar approach from the companies? You mentioned, data disclosure still a major challenge, target setting, response to investor engagement, such as what we've seen from IFM or what we're seeing on the credit risk rating or analysis side. How engaged are the companies themselves in these sectors in terms of actually embracing the disruption and the need for transition?
Generally speaking, I'm strongly of the view that the corporate world has had an edge over finance, actually ahead by 5, 7, almost 10 years on occasions, because corporate strategies are often designed in a long-range thinking. And over the past 20 years, you can argue business models have fundamentally changed, and that transformation is, of course, still ongoing. Basically, you can argue it's from an industrial era thinking towards a future-fit thinking, and you can then break it down by corporate function along all the value chains, and obviously it's an ongoing transformation. But the corporate world is interpreting the trend lines, the long-term trends, but the degree to which action actually happens has a lot to do with the environment, the market. Finance has caught up, I would argue, and the beauty now is that because of availability of data and information, finance actually is on par with the real economy. And for the first time, in my observation, there is now a convergence between this corporate movement of transformation and the awareness of finance to pay attention to risks and opportunities not traditionally captured in balance sheets. And that's the historic opportunity we're in now, this convergence of sustainable finance with corporate sustainability. There's still a long way to go. I would argue I've seen many corporations where the change happens really at the strategic level, making the right bets, and many bets are still ongoing. Will this new technology actually work or not? But it takes a long-term view and a willingness to take risks there as well. There's nothing is assured in the marketplace. And we have this contradiction that it still makes financial sense to burn the globe. The efficient market theory clearly confirms that. Price signals today, as we speak today, it makes sense to burn the globe financially, short term. So we live in this contradictory world, and yet we know that price signals will adjust. We don't know quite when. We don't know which models will dominate. So we are in this shadow world in between, but the willingness and the awareness to shift is now there. Disclosure in the corporate world has progressed enormously. When, like 20 years ago, the first benchmark measures, GRI, tried to get traction in the marketplace. Now, carbon disclosure is obviously a priority, and I believe TCFD is the right framework for pushing this forward. It's a great framework because it looks into the future, strategy, governance, targets, performance. So I think there's great momentum, but unless at some level playing fields kick in, also at the regulatory side, we won't have the scalability of the transformation, and we won't just make it, so to speak. So the convergence of finance with business, historic opportunity.
Yep.
Huge progress we can build on the corporate side. Technology, clearly the key driver, I would argue, and the cost factors associated. But the preference setting and the price signals adjusting now probably more rapidly. We hear insurance, but all over the world you see the first signals how adjustments are happening, whether it's in property markets, whether it's in agriculture, steel production.
Yeah.
I just hope the world will be converging and not introduce then walls and barriers and create little islands of high carbon monopolies versus low carbon. So there's a real political dimension too of fragmentation, and we should really also think about how can we ensure that the world sticks together, and maybe, just maybe, climate impact will become the common enemy.
It definitely feels like it's a challenging time geopolitically to be having a very challenging debate on impacts for very challenging industry sectors. And local politics isn't helping in many ways as well. I mean, it seems like we definitely have a perfect storm of challenges, shall we say, in terms of dealing with these issues. But, I mean, Samuel, I'm keen with the disclosure. I mean, we know that TCFD in a short period of time has had a major impact in terms of underpinning and driving a lot of that change. You know, how is that flowing through also in terms of fixed income? And the increasing sophistication in the fixed income world around taking these sorts of carbon risks and translating them on both transition and physical risk side into different types of analysis as well. I'd be interested to hear more about that, given it's such a key focus for so many investors.
Sure. So indeed, there has been a very strong momentum in terms of disclosure driven by the TCFD, as well as some jurisdictions taking action accordingly, with the Article 173 in France on investors' disclosure being a case in point. There is more data. The question is about the use case and obviously about the underlying quality of the data in terms of possible use case in an investor context. So when we think about TCFD, there is a wealth of data that are important on the governance and strategy. But at the end of the day, when we take a step back and we look at the portfolio, there are just two key overarching questions. The first one is about the underlying financial and credit risk. So in relation to TCFD, that's mainly in the context of scenario analysis. Can we quantify that, and can we map in a consistent fashion the way issuers report data on their future exposure to an accelerated energy transition, or at the other end of the spectrum, a failure to act on climate? The second question is about the alignment with the Paris Agreement. So that's related, but in practice there is a nuance when thinking about the methodology and the data that is needed to understand whether an issuer is Paris aligned or is consistent with the Paris Agreement when looking at its future carbon emissions and technology exposure mix. So the next question is about how to build this sort of harmonized interpretation of TCFD. I have to highlight the very positive role played by certain initiatives such as the Climate Action 100 Plus. And we have been a member, and the extent to which they built a sort of benchmark of the world's biggest carbon emitters on a range of metrics, largely driven by TCFD, in order to map them across the spectrum. Has been tremendously helpful in order to take that sort of data to a concrete sort of implication at a portfolio level in our context. That means that we can integrate this data into our toolkit and into our ESG products at the end of the day, because we want for ESG portfolios, in particularly our emerging climate-focused investment approach, that it is a core component that we focus not only on the mitigation of the financial risk, but also on the Paris alignment question, and that we select issuers that are at the forefront of this trend, whether because they are green bonds issuers, high-quality green bonds issuers, whether they are transition leaders in their respective context, and whether they demonstrate evidence that they are indeed at the forefront, based on a robust methodology and framework and long-term business outlook. An example I'd like to highlight on that front is Enel recently, because it has been an early TCFD supporter in Europe and globally. Ultimately, as part of its TCFD and low-carbon strategy, it eventually issued an SDG-linked bond that is linked to its renewable targets and greenhouse gas emission reduction commitment. I think that's a good example of the journey from TCFD disclosure to a strategy and subsequently an investment product or an investment mechanism that is attractive and showing the direction of travel.
Yeah, I mean, it's interesting, the data question and the analysis question, and then what do you do with the information, and then how do you invest against it, is something which seems to be a recurring issue for investors on so many different dimensions. And then also, how do you actually interpret progress? What does good performance look like against those analytics? And certainly for Climate Action 100, I think what we've tried to do is actually put together a framework of lots of different metrics to try and understand the industry sector issues, but then actually build up some form of consistency across the industry sectors as well. So building that metrics is one aspect of it, and we've just shamelessly drawn on everyone's expertise. But then turning that into an investable piece of information or a data point which you can consistently measure against, I think is a whole new frontier of work that seems to be very actively being pursued across the industry. But I guess I'm also interested, Peter, bringing it back to Australia again, looking at the work that we see and looking forward. I guess where do you see some of the biggest areas of opportunity for future investment in Australia? I mean, it seems like transport seems to be a bit of a screaming area of assistance. But where do you see some of the biggest area of future investment across infrastructure in Australia in particular over the next 10 years, say?
I'll just mention two areas of, I think, particular interest to this group. The first is transport, and I'd make two reflections on transport. The first is that it's the last real public utility in a sense that largely government funded, largely unpriced. Government subsidy, of course, covers much of the costs, around 70% of the operational costs of urban projects and around 90% of the costs of regional projects. But that's going to change. And it's going to change in part because of the emergence of electric vehicles and because of the decline in fuel excise revenue. So there's been a long conversation in Australia, probably as long as the conversation about climate change, frankly, in terms of reform of the way we pay for roads. But I think that reform is finally a solution with a problem to address, rather than a solution shopping for a problem that it's relevant to. So I really think we're on the edge. It's not an issue for tomorrow, but we're required, more particularly, to look out over 15 years. And I certainly see within that time horizon there being a large transformation of the transport sector where fundamentally the way it's priced and the way that revenue's raised and distributed will change. And that is a fundamental change in a massive part of the infrastructure sector. There's also, within the transport space, a growing mood to if you like, embracing public transport. We do see, or we have seen, increased public transport take up, in part because of, changing consumer preferences, but really the continued densification of our cities. So Sydney, Melbourne, Brisbane and Perth will accommodate 75% of growth over the next 2 decades, and 70% of the growth in the respective cities of Sydney and Melbourne will be infill development. So we're going to have much denser cities. That is a good thing fundamentally for infrastructure demands, but it will mean that public transport is more and more important, and our big cities will not function effectively without the types of transport networks that we see with Sydney Metro, for instance, just to call out one investment. So there is absolutely opportunity in transport, and it would be remiss of me not to mention, beyond electrification, sharing, connectivity, and of course automation for the private vehicle. We're in a generational change in transport, not seen for 100 years. Switching to energy, I mentioned it before, but firming capacity is critical in the current environment. And, I know there's been lots of conversation here about renewables and equally about firming, but I just can't emphasise enough that we see almost a switch being flicked in terms of what's critical for the stability of the grid. And we are going to see much greater focus on firming capacity, and it will be interesting to see whether or not we're sophisticated enough to take a view of the risks that are associated with emerging technology in that space. And then, of course, another issue that I know there's been some time spent discussing here is the network, the transmission requirements attached to the transformation to new fuels. It's not a bad time to be building power lines, is the way I'd reflect on it. Certainly, there is a huge amount of investment that will be required for the new fuel transition in transmission. And then separately, because of electric vehicles, there will be an immense level of investment required in the distribution network unless we can manage peak charging. So 12.5 million level 2 chargers will be required by 2040 in Australia. It's the equivalent of 12.5 million hot water systems rolled out across the established distribution grid. That it will create absolutely pressures on that network unless we can shift the way we price electricity, and there's a big conversation there as well.
All right, so a few issues there, but I'm conscious of the fact we're coming up against time, so I am just going to throw it open to the questions at this point and let you decide which way to take the conversation next. If you do have a question, please put your hand up, otherwise I'm going to keep asking questions. Yep, we have a question up the back.
Hi, I'm Shahini Parker from Calvin Transition Consulting. There was some conversation around energy costs and insurance costs already being seen across the sector. With the companies I work with a lot, one of the other tangible impacts is unplanned downtime and the increase in unplanned downtime, and it often can actually affect the bottom line results at the end of each year. And these same companies are investing quite serious money internally on their maintenance programs, their reliability programs, and the metrics that they use to measure the return on those is uptime and enhanced uptime. So with infrastructure, when a piece of critical local infrastructure goes down, it can affect obviously a number of these companies with operations in the area. And I'm just wondering if there's an opportunity for some more sort of finance to be thrown at the infrastructure sector from the companies that will be affected in this way through increased unplanned downtime, and whether they might see some real financial return in collaboratively investing in some of these assets to enhance their own uptime performance in a similar way to how they do it internally.
Anyone want to comment on that? Mike, I see you're nodding.
Yeah, Shane, hi. Take a couple examples just to highlight just how we're thinking about that. And this is probably for another conference, but the biggest risk that we've got across our infrastructure portfolio globally is, in terms of downtime, is cyber risk, and a completely different subject. But in terms of where technology and effort is being put at the moment, that would be the single biggest step change in terms of effort and investment that we've made across our infrastructure portfolio over the last 2 to 3 years. Because the stat we got, I was at board subcommittee meetings yesterday at Ausgrid, and we got a monthly briefing on cyber risk, and we're getting 360 attacks every second and I won't name the jurisdictions where they're coming from, but you can probably guess, but 360 attempted infiltrations every second of every minute, hour, day. So that gives you an indication of just how significant the risk is and the amount of effort that now. We've got a team of, I think, 10 in Ausgrid managing just cyber risk. So different topic for a different day, but downtime is a huge issue for us. Again, in Ausgrid, you look at storm activity, physical
risk, yeah.
Physical risk. So the storm activity over the last 12 months was 3 times greater than the previous, I think, 5 years. The regulator gives us an allowance for downtime if it is caused by genuine storm activity, but it ultimately is a cost to the customer, and if we're not managing the network as well as we should, then the regulator will look for recompense from Ausgrid, and we're looking at every thing we can do, technology as well as physical asset management to reduce downtime from storm activity. And a sort of final point I'll make is, the board actually went off to California last year. We spent time looking at companies like Google, Apple, Amazon, Intel, Facebook. They are all extremely active on the energy front, looking at ways to take a part of it. So we're seeing non-traditional players on the energy front with big data, banks, great customer service and interaction and customer relationships, and big money and big brains. We got 20 PhDs in one room, we saw at one point, all working actively at ways to disrupt the energy sector and play a role. And there's one way to look at it. You can look at it as a risk and a threat, or you can look to embrace it and bring it on board. And I think it's imperative on all infrastructure companies, and certainly in the energy space, to think about being much more innovative around technology and embracing change rather than trying to hold it back and react adversely to it. So.
Yeah, Peter.
Just to add one point quickly, I completely appreciate all of the points that Michael's just mentioned and see the level of sophistication within business to think about those risks. I have to say, though, I don't see the same level of sophistication in government decision-making processes. So there is a great deal of focus on cybersecurity risk at a national security level, but our tools to prioritise infrastructure investment, and we are the gatekeeper to some of the most precious tools, fundamentally are not capable of assessing these risks, even to the point of assessing downtime over a project lifecycle. So we have called out some of those shortcomings in the audit, and shameless plug again, read the audit. It's only 643 pages, it's light reading. There's about 2,500 pages of technical reports as well, you can probably skip those. But fundamentally, the way our decision-making tools allow governments to prioritise their own action needs to be more mature, so that issues like these, issues like the ones you're discussing here, are prioritised. And unless we see, if government won't take action politically, then we need to see the practices that sit outside of the political process sufficiently sophisticated in order to prioritise action.
Well, I'm going to take prerogative for one more question, even though we are a little bit over time. Sorry, one more question down this end.
Hi, my name is Klaus Weber from the Australian National University. This question is probably a bit more relevant for the previous session, but I'll ask it here anyway. So we had a lot of discussion yesterday about, and also this morning, about the very damaging impact of various PR campaigns that have been run very successfully by groups like the Koch brothers over decades, and that impact continues to this day. And it influences our politics, and it influences the politics because it creates confusion in the public. So my question is, why do we not have a campaign on the other side of the fence that is equally well coordinated and aims to better educate the public and also change the sentiment within the public to enable a faster transition in terms of our politics?
I think we were all agreed you're going to answer this one.
Yeah, no, living in the US for 30 years, I have lived through these waves, but recently I spoke to a meeting of CFOs, and for the first time in 30 years there was willingness to listen. I was really surprised, so I'm just a positive sign happening. But concerned scientists, we heard from science very compellingly this morning how the best response should be orchestrated, and luckily more and more are stepping up now. In the US, concerned scientists are very active. Many other fora are created. At the end of the day, we really need to ask what kind of benchmarks can we rely on, and it is science. So we have to go back to science. And yes, it's a dynamic with not everything is nailed down, but we have to listen to science, and it's all our challenge to stay rational, to try to make sense out of a complex world, not getting carried away by emotions, and avoid. Climate change doesn't have a political color. It's not red or blue or green. It's science evidences behind what's happening and what causes it. So we have to demystify and depoliticize. On the positive side, in Europe, there are new alliances now coming, especially driven by energy transformation issues and transportation sector movements, where CEOs of leading companies are now teaming up with green parties, unheard of years ago, forming whole new alliances to win over the mainstream parties. And you see the shaking up of the political landscapes that is happening. And of course, it's the young people. It is, at the end of the day, an intergenerational issue. I think all of us, we are lucky, we are well off, we lived in peace, we're doing well. But what about the next generation and the one behind us? So this intergenerational dimension is very, very important. And Greta and the movement, I think, are very important. And I wish politicians had the courage to face this movement and say, yes, we have failed. We have not done enough. Let us make a new start right now and do much, much more. You are right. So there's a lot of good things happening, and I think the tipping point is now kicking in, because in market senses, the solutions are increasingly viable. They are there. They're ready to be harvested. Yes, the old is still resisting, as always, but the new is gaining strength. So now is the time to really kick in.
Peter, and then Samuel, also just to have the final word.
Just quickly, I just want to say, let's not forget politicians do have a role. Their role is to reflect the view of the community, and I don't see any benevolent dictators around, so democracy seems like the best form of government for us, so their role is one that will continue into the future. So I just want to raise 2 points. The first is, we ask the community what issues they're concerned about in the electricity space or the energy space, and for that matter, more broadly. 70% of people in the community were concerned about energy prices. A fraction of that were concerned about climate action. So it's an issue that, of course, is important, but it's not an issue that's well understood. And the burden doesn't sit with others, it sits with the people in this room to communicate with the community and to help explain a horrendously complex industry in electricity, to also explain a horrendously complex issue of climate change. If we want to take the community with us, then we need to connect with them on the issues that are important to them. And Bayard Jafari, who runs the Electric Vehicle Council, is often known to say, if electric vehicles were a cost of living measure, we'd have them by now. Instead, they were cast as a climate change initiative, so they've become a political football. I'm
wary about getting back into last night's dinner conversation about why is climate change so hard. But Samuel, maybe I could just bring it back to that question around in terms of final comments as well.
Sure. So maybe some quick reflections on that topic. And a note of optimism more broadly. I believe that the role that has been played by the Sustainable Development Goals in terms of connecting climate with other issues that are tangible to people, thinking about health in relation to CO2 and externalities, thinking about indeed the sort of jobs and just transition concept, thinking about water, thinking about a range of issues that are perhaps more concrete and for which the case for action and the sort of science underpinning action and the impact on communities, workers, and various other stakeholders is perhaps more easier to grasp rather than having to explain and walk through the IPCC key takeaways. I think that food is a good example with the IPCC recent report on land use. Subsequently, if you look at the awareness associated with the health impact of your diet and the underlying CO2 emissions, I think that's quite a powerful, concrete example where there has been a growing awareness of the science underpinning both the CO2 and broader externalities dimension in a short period of time.
Yeah, okay, good point. All right, so I am going to draw it to a close there, 10 minutes late. But I guess I just wanted to reflect on the fact that this morning I think we've heard from the science, we've heard from the politics, and we've heard now in terms of some of the disruption that we're seeing in key industry sectors. After morning tea, we are determined to get into the solutions and to really start taking it down a level in terms of looking at what's being done, what tools are emerging, what frameworks are emerging, and how investors are actually responding to these challenges to constructively and productively move forward in terms of progress and action against the Paris Agreement and getting to those really important net zero emissions goals and Paris-aligned portfolios. But in the interim, please join me in thanking the panel. I thought that was a fantastic follow-up to the policy discussion. Thank you. And please feel free to grab a coffee as well. Thanks.